Ladies and gentlemen, good day and welcome to the Shri Keshav Cements and Infra Limited Q4 FY25 and FY25 results conference call hosted by Kirin Advisors Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harshil Ganshani. Thank you and over to you, sir.
Yeah. Thank you so much. On behalf of Kirin Advisors, I welcome you all on the conference of Shri Keshav Cement and Infra Limited for Q4 FY25 and FY25. From the management team, we have Mr. Venkatesh Katwa, Chairman, Mr. Vilas Katwa, Managing Director. Now I hand over the call to Mr. Venkatesh for the opening remarks. Over to you, sir.
Thank you, Mr. Harshal. Good evening, everyone, and welcome to Shri Keshav Cement and Infra Limited's Q4 and FY25 earnings call. I really and sincerely appreciate your time and interest in joining us today. Shri Keshav Cement and Infra Limited, which was formerly known as Katwa Udyog Limited, is engaged in manufacture of cement and generation and distribution of solar power, primarily in the state of Karnataka. Our cement plants are situated in the Bagalkot district, while our solar power operations are located in Koppal. Our distribution network spans North Karnataka, Coastal Karnataka, Goa and parts of Maharashtra, supported by over 350 cement distributors and 600 retail touchpoints and over 14 solar power consumers. We have secured a credit rate upgrade for our long-term bank facilities, advancing from IBR BB positive to IBR BB B minus with a stable outlook. And on the short-term facilities, received a short-term rating of IBR A3. This year marked the completion of our cement plant of 1 million ton capacity with the kiln commissioning in Q4 and also an addition of 3 megawatt of renewable power, making it a total capacity of 40 megawatt. Now let me take you through the performance of FY25. FY25 was a year of recalibration amid macroeconomic and sectoral headwinds. While total income for the year remained stable at 124.6 crores, our EBITDA stood at 25.17 crore, maintaining a healthy margin of 20.73%. Despite revenue pressures driven by subdued infrastructure demand and policy uncertainties around renewables. Our emphasis on the cost efficiency and internal controls helped us preserve the profitability. Looking forward to FY26, we remain very optimistic. Our newly commissioned kiln began operations in March 2025, which will support our capacity expansion to 1 million ton per annum. The project is expected to unlock scale benefits, optimize energy and fuel consumption, and position us for the higher market share and improved margins. Additionally, the increased allocation towards public infrastructure and strong real estate momentum are likely to drive demand for cement in our key markets. Our strategic roadmap continues to prioritize capacity optimization, green energy integration, product mix enrichment, and expansion to new geographies, particularly high-growth urban centers like Pune, Bangalore, and Kerala. So before I hand over the detailed financial discussion, I want to thank you, our stakeholders, partners, customers, and employees for their continued trust and commitment. Your support remains the foundation of our progress. With this, I'm very pleased to open the floor for the questions. Thank you once again, all of you, for being with us today. And I'm open to the questions now. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bharat Gupta from Fair Value Capital. Please go ahead.
Thanks so much for taking my question. Sir, I have a couple of questions. So first, in regard to the price realization, so can you provide some colors? What has been the realization trend during the quarter 4 and what's the trend currently?
Sure. So if I do some comparison about the naked cement rate, which is what we use as a benchmark to understand the net realization. So compared to FY24, the net realization decreased by around 425, which was a major impediment in achieving the EBITDA margins as well as EBITDA figures. Even the Q4, in spite of our uh, capacity utilization reaching 92% from 79.5% in the Q4 FY24, the cement price reduced by almost 11.5%, and even the renewable price also reduced by about 12%. So typically, the naked realization was around 3350 in FY25, similar which is in Q4 itself. However, there was some beginning to increase of the price by the end of March, and there seem to be some better realizations going on in Q1 of this year. But then, for sake of Q4, the NCR was pretty much low compared to the previous quarter of the previous year.
Okay. And so the current realizations are nearly the same as it was in Q4.
The current, you mean say Q1 FY26, or you're talking about?
Q1 FY26.
No, Q1 FY26 was better off because the price has generally increased in the south, and pretty much what is happening with other plants, we are sailing in the same boat.
Okay. So secondly, with respect to the demand recovery, so how do you see the demand playing out currently with the early arrival of the monsoon? So do you think the demand recovery can take a longer time? And also, like, can you just brief us about the new capacity, whether it has stabilized or not? And also with regard to the guidance which you have shared earlier with respect to FY26 and FY27, so are we sticking to it?
So as far as demand revival, yes, there has been a strong demand revival in the Q1 itself of this year because there has been a general uptick in consumption of cement. Of course, first 2 months, which was like April and May, was pretty much in line with our targets. We increased the sales. However, the early monsoons have kind of shown a little step down on the dispatches, but we are hoping that these monsoons are going to be short-lived, and again, before the real monsoons arrive, there should be uptick in the demand as well as dispatches. However, even during the monsoon, it is pretty much expected that the cement industry was expected to grow this year because last year there was not significant increase in dispatches all across India and particularly in South India. So we would be able to achieve the rated 50% utilization throughout for the FY26, and we think we are already on the course of it as of now. So yeah, this is about it.
And with respect to the new kiln, which the project has been commissioned, I think. So the plant has been stabilized. And with respect to the guidance which we shared earlier of 70 crores plus, I think EBITDA for FY26, like, are we sticking to it? And what can be the PAT guidance for this fiscal year?
So typically the guidance was based on the realization what we get. If there's a kind of relation we have got in May, if that continues to stay and if it improves, we will be on the target regarding the PAT as well as for the EBITDA figures. However, the new kiln has just commissioned by end of March, so we are going through the standard operating procedures, and slowly the kiln is improving its performance, and as we speak, we're almost reached 70-75% of its rated capacity. Expect to reach the rated capacity by the end of this quarter. So with that, I'm still hopeful that this year, hoping that the price continue to remain as it is, we should be able to comfortably achieve the EBITDA figures.
And that would be like, roughly, can you provide a ballpark figure, like what would be the range of PAT during this year?
So technically what has happened in the past is whenever we have discussed the fact, because of a lot of Ind-AS adjustments, and particularly when we are investing in the huge assets like solar capital investment, where there is a huge capital investment. However, since it is used for captive, there is an element of deferred tax which is appearing on the books. What I could, give a foresight is on PBT, profit before tax, and with EBITDA of around 70 crores, we can expect a PBT to be around but 30 to 35 crores. So that's the kind of foresight we are having for this year.
Sure, sir. And just a last question. What are the debt repayment plans and any CapEx which we are looking for doing out this year in solar as well, in solar particularly?
So as said, the discussion is being going on internally to add another 30 megawatt. But like discussed last time, it has not come to a final conclusion yet. And if it happens, there is going to be an additional 30 megawatt adding up this financial year. But that once it is confirmed and finalized, it is going to be evolving by itself. So debt is being reduced on a consistent basis. Even last year, around 26 crore debt has been repaid. And if you look at the long-term debt, in spite of having a new plant at, in spite of having a new kiln, the debt has not increased significantly. But as we start gaining profits, the first course of action is to reduce the debt as soon as possible.
Sure, sir. That's it from my side, sir. I will join back the question queue. Thank you.
Thank you, Bharat.
Thank you very much. The next question is from the line of Abhishek Sharma, an individual investor. Please go ahead.
Hello, am I audible, sir?
Yes, Abhishek ji, yes.
So my first question is, what are your plans for further solar capacity expansion in financial year 26 and beyond?
So company believes that, since we already have a 40 megawatt and the management believes that renewable power is one of the industry which we would like to even further focus on. So like mentioned earlier, right now about 30 megawatt is on the cards, and it might take a while before, concluding on the project and then coming back to the investors. So for this year, if anything has to happen regarding renewable power, it is going to be addition of 30 megawatt. And after that, the next 3 to 5 years, company does have plan to increase the renewable power capacity to beyond 100 megawatt. And that's the timeline what we are thinking about. And regarding cement, as such, we are going to continue with 1 million ton. And once this stabilizes, there would be a possibility of further growth after a few years down the line.
Okay. And what is the expected payback period for the kiln modernization and solar expansion investment?
The kiln modernization, we are talking about between 7 to 8 years, is a typical payback period with the kind of power and fuel savings. And solar also typically about 6 to 7 years based on current regulatory, cost and the pricing available.
Okay. And so my last question is, with the total solar power installed, what is the current captive consumption versus external sale ratio?
So right now, as we speak, our captive consumption for this, till last year, it was around 40-45% was captive consumption. This year, with the 1 million ton, taking up to nearly 50 to 60% capacity, we are hoping to achieve around, maybe about 60-65% of power to be utilized captively within the existing 40 megawatt, and balance will be sold. Once we reach around 80 to 85%, we will be, utilizing around 95% of our capacity, renewable power capacity.
Okay, sir. Thank you.
Sure.
Thank you very much. The next question is from the line of Hemant, an individual investor. Please go ahead. Mr. Hemant, please go ahead.
Hi, sir. Good evening.
Good evening,
First of all, congratulations to you on starting the upgraded plant. So my first question is related to this tax for FY26. What will be the tax percentage for this year?
So since we already have a lot of carry forward depreciation loss in the income tax books, we would be looking forward to have the, MAT, which is around 15 to 16% for next couple of years.
Next couple of years. Okay. And what will be the depreciation and interest amount for this year?
So this year with the new CapEx, the interest amount is going to be in the range of around what 25 crores with the new addition of the loan, and depreciation is going to be also in the range of around 18 to 20 crores.
18 to 20 crores. And what is the capacity utilization in Q1 till now for the upgraded plant?
I'm not sure if I can give out those figures, but it is much better than Q1 of the last financial year. It has improved drastically. The dispatch also has improved in line with our expectations. So pretty much what we are thinking of reaching out a target of 50% this year on overall basis. Even though we are kind of starting off ramping up slowly, we should be able to achieve about 50% capacity utilization in this financial year.
In the whole year. And as we are starting to consume this solar capacity internally, are there any chances to lose the 12 to 13 customers we had till now?
I didn't understand the question.
If we start consuming this solar internally, so we can't sell it to the existing customers, right? Till the new upgradation happens. So what's the plan to keep those 12 to 13 customers?
So assuming that we don't add another 30 megawatt this year, yes. So eventually we will be starting to consume nearly 60 to 65% of our capital and still sell it 35%. And once we keep on increasing the capacity of our cement plant, the selling portion of renewable power will start reducing. But that is assuming that we don't add 30 megawatt, which is already on the cards right now. And in any case, if either we sell it or consume it, they basically, if we have not sold it to that extent, we would have saved it in any case. So the EBITDA for solar very specifically will continue to stay on the books.
Okay. And how much time it might take to start this 30 megawatts if we have any plans?
So technically, once we start the process, it will take about, it will take roughly around about 9 months to 12 months.
Okay, so that's it from
With all, from the point of getting approach all the way till the date of commissioning.
Okay, sir. Thank you so much.
Sure, sir. Thank you, Amanji.
Thank you very much. The next question is from the line of Aditi Roy from Kirin Advisors Private Limited. Please go ahead.
Good evening, sir.
Good evening, Aditi.
My question is, with over 600 retail touch points and 350 plus distributors, what initiatives are being taken to increase market penetration in FY26?
So as such, we have drastically increased our sales and marketing team across the board in all the regions and last year itself. And we are already beginning to see that benefits accruing in this quarter. And typically, company is going to work towards a lot of new digital and sales marketing techniques to increase the penetration. So what I mean to say is we are looking forward to increase our market share. Plus, now that we are a 1 million ton plant, we qualify for a lot of government-related projects, which we were not qualifying earlier. So that is going to be an added benefit, and the company is already actively pursuing with, state government for state-level projects. And, as such, we have already achieved some breakthrough. And, in times to come, we will start selling to the state government and the state-related projects too. But the company is actively working on many other initiatives to, increase the market penetration and also add to the new areas farther off better areas like Pune and Bangalore if there is a need.
Okay, sir. My next question is, what is the company leveraging digital tools or data analytics to optimize distribution and dealer engagement?
Are you asking me if we have a data analytics to address the sales and marketing?
Yes, sir.
So we have our own internal, statistics to know which area and what area we're covering. We are using a lot of digital analytics to see, for example, we have some incentives for the end customers, basically, with the point system by which, if they order once, they'll keep accruing points, and then with those points they can get certain benefits and gifts from the company. So that is becoming, a good strategy for us, because till now the incentives were only given to the dealers and retailers, but now we are reaching out to the engineers, the masons who consume our cement, and they pretty much get those points. So some of these activities are already helping us, and we're seeing that increase in sales this quarter.
Okay, sir. And my next question is, what proportion of revenue is expected from solar sales versus cement post the shift in captive usage?
So then, with if the more I use captive is better for me, because eventually cement is the mainstay of the business. So as we keep increasing the capacity utilization, so we would be expecting eventually 95 to 96% of sales coming from cement, and only the balance coming from solar. So and this year maybe it is going to be, compared to last year, the cement sales percentage will increase this year because of the bigger capacity and the higher captive production. So yes, eventually solar sales is going to be extremely reduced till we add another solar power plant.
Okay, sir. And my last question is, are there plans to diversify into adjacent building materials or enter new regional market?
There are a lot of plans. We already have consultants working on what is the next best course of action. Just that, we haven't reached a point of conclusion that we would be certain to go in that direction. But as of now, apart from renewable power, we're also thinking of RMC. With RMC, what is going to happen is, when we start consuming the cement internally, increase in RMC would mean that we would be reaching the end customers, plus the top line, and will increase drastically. Plus, there is going to be an addition of EBITDA margins. We would be looking, into RMC too very soon. I think maybe another quarter or so, we would have some understanding on which direction we want to go.
Okay, sir. Thank you, sir.
Thank you very much. The next question is from the line of Bhushan Singh, an individual investor. Please go ahead.
Yeah, thank you so much. So, sir, is the company evaluating other sources of alternative energy or waste heat recovery to further lower energy costs?
Yeah, thank you, Bhushanji. So typically what we are looking right now is waste heat recovery may not be something which is urgently required for the company as of now, because we having our own renewable power, and production of our renewable power cost is less than 1 rupee 70 paisa or 1 rupee 80 paisa per unit. It may not be a pressing need for us, even though there is a possibility and a scope to do it sometime in the future. But alternative fuels, yes, once the kiln stabilizes, we would be looking into the possibility of alternative fuels, because this project, when it was done, we have made some civil provisions to utilize the alternative fuels.
Okay, and sir, what portion of your energy cost is hedged or contractually fixed under current power purchase agreements?
So typically our solar renewable power projects were commissioned in 2018, which had a government related incentive wherein we could sell the power to anyone without any regulatory cost. This being the case, the company thought it strategic not to sign a PPA. And the reason is, with the PPA, you could have been bound to, the price would have been fixed. And if we had signed the PPA in 2018, the price would have been around, 5 rupees, 5 rupee, 10%. But today we're selling at almost at the rate of 6 rupees because we did not sign the PPA. So company is selling with, on the basis of letter of interest from various consumers. And as such, we are getting a very good price as well as a very good easy sales on renewable power is concerned. So PPA is not considered this time.
Okay. Sir, what is the current outstanding debt, and how does the management plan to maintain a healthy debt-to-equity ratio post-CapEx?
So as such, right now, our debt to equity is, I think, less than 2. And management, the newest debt which has come up last year is because of this CapEx, which is showing on the books. However, the benefits of the debt is going to accrue this year. So as we move forward, the current profitability as well as from the improved margins, we will start paying the debts as when company has some excess cash that will be generating.
Okay. Sir, has the company encountered any regulatory or environmental hurdles during the expansion phase?
Not at all, because we have taken all the clearances from the, be it environmental or all the clearances before starting the project. In fact, if you look on our balance sheet, our long-term borrowings has increased from 165 crores to 169 crores, increase of just 4 crores. That is mainly because most of significant debt has been repaid last year with the new debt of around 26 or maybe about 30 crores coming on the books last year. We paid around 25, 26 crores. So net debt increase has not been very significant. Even the capacity increased 3 times now.
Okay. Are there any strategic partnerships being explored to improve product reach, technology, or financial strength?
So partnerships, when we talk about partnership for sale of cement, typically not in the format like, we are having some kind of a fixed sale agreement or something like that, but we are reaching out to institutional buyers as well as the government related projects, and we are beginning to see some kind of a success in both these regions. And, we are also talking to few, RMC, large RMC, plant chains, and, we are beginning to have some kind of some progress in that. But for now, we have got some breakthrough regarding government related projects. So maybe by the end of this quarter or beginning of next quarter, we should see that showing up on the books.
Okay. Thank you, sir. That's it from my side.
Thank you, Bhushanji.
Thank you very much. The next question is from the line of Riya Gandhi, an individual investor. Please go ahead.
Hi, am I audible?
Yes, ma'am.
Yes, Riya.
So how is SKCIL positioned to benefit from the government of India's infrastructure pipeline?
That would be a great news, because last year typically what happened was the first quarter started off with the elections, next monsoons, and third quarter, government barely firming up to start the projects. So it is the fourth quarter where actually government started involving itself into setting, for the large infrastructure projects. But at that time we were not qualified because the size of our plant was not something which, we could pass the bar of a qualification. But now with the 1 million ton plant, we would be qualified and then looking forward to venture into government related projects. Government has got a huge push as well as rural housing and highways and other infrastructure projects. And I believe we are already seeing that benefits in this quarter and will more likely continue in this entire year. So with this government push, we are hoping that dispatches as well as the pricing will improve in for this financial year.
Okay. Also, what macroeconomic or policy risk, example, coal power tariff, construction demand cycles, could materially impact performance?
Typically, anything that, see, apart from monsoons, which is cyclical and affects all the industries, any act by the government wherein it is a lack of infrastructure or a delay in infrastructure projects will definitely, impact this industry. And for now, with even the petroleum coke, what we are buying has shown a lot of stability in the entire last year, and it is expected to show the same stability this year. In fact, the management is hoping that the price of fuel will start reducing a little bit because a lot of alternative type fuels have emerged all across the world, and that is most likely going to help this industry, which depends significantly on fossil fuels. So apart from any drastically increasing the fossil fuel cost or petroleum products, or any delay in any infrastructure executions, I don't see any policies other than this would impact this industry as such.
Okay. Thank you. There's one last question from my side. As one of the few cement plants running 100% on green power, is the company exploring carbon credit monetization or ESG-linked finance?
So carbon credits, there are certain carbon credits generated based on a renewable thing, but the monetization of that is not very significant. In fact, last year was, at least there are some better pricing, but last 2 years we don't see any good pricing for carbon certificates, and we are accumulating them till we get a certain price level. Regarding ESG, yes, once the kiln stabilizes, company is, the larger part of ESG we have already complied by being 100% renewable power compliant. But there are a few other steps which company will continue to do to focus on ESG.
Okay, thank you. That's all from my side. Thank you so much.
Thank you, Ria.
Thank you so much. The next question is from the line of Priya Jain from Green Capital. Please go ahead. Priya Jain, please go ahead.
Hello.
Yes, Priya, go ahead.
Hello. So I have a few questions with me. So what is the break-even point in terms of capacity utilization for the newly expanded cement plant?
So with the current pricing, our break-even point will be around 37 to about 40% of capacity utilization.
So also, amid the rising demand for the real estate and infra sector, is Shri Keshav targeting any specific large-scale institutional clients?
So in general, the company is approaching institutional buyers. There's already been a significant uptick in rural consumption of cement, which is where our company is focused on. Apart from institutional buyers, we are also looking at government-related projects, and like mentioned earlier, we seem to have some breakthrough, but we will see some benefits accruing at the end of this quarter or beginning of next quarter.
So I've been following Shri Keshav points since good amount of time. When can we investor expect a positive path?
I think this financial year should be something we should typically expect. In fact, the last year also, the PAT was negative squarely on account of the deferred tax liability, which otherwise, company is making healthy cash profits because of the huge capex and depreciation. We are losing out on PAT. But this year we should be able to achieve positive PAT, definitely.
So also, are there any updates or expectations regarding government subsidies or incentive for renewable power producers in Karnataka especially?
No, as such, right now, the incentives are only applicable to the captive power generation. So, which is why the company is considering to set up another 30 megawatt, because our existing power plants do already have incentives when we sell the power. But today, if we have to set up a renewable power only to sell, I wouldn't consider it a very promising industry as such with the current regulatory framework. However, with the current regulations for the large scale capacity, of course, there is already a scope for be it captive or independent power producer to sell the power. But as such, for our existing whatever incentives we got will continue for a few more years because of the time limit. And then if the 30 megawatt is materialized based on being captive consumption, those regular exemptions for regulatory expenses will not be applicable to us.
Any timeline, sir, you would like to quote for this project completion? 2-3 years or whatever, anything?
No, it won't take that long. I mean, typically by the end of next quarter, we should have an answer on the shape of this project. And, if happens anything before that, we will definitely publish it. But as such, it is only on discussion stage, evaluation stage, and, economic evaluation of the plant.
Also, any expansion plans beyond the current geography?
As such, we are deeply penetrating the existing geography, and like I said, this quarter has been fruitful in as far as dispatches are concerned. But yes, as we grow, as our plant starts to stabilize, our kiln starts to stabilize, all the machinery start to stabilize. When we start getting the increased production, company will look at new geographical areas, bordering the existing geography area, increasing geography by another 50 to 100 kilometers, probably reaching out to Pune and Bangalore. With that, the consumption pattern in these areas would far outstrip our production. So yes, there is a scope for that, but we will approach it as and when our current kiln stabilization takes us to a 100% level.
So as we know that cement has always been a very attractive sector from investor perspective. So is there any specific sales strategy Shri Keshav follows?
So a very specific strategy, what I would say is one strategy which worked us very well is 100% renewable power, which is, we were the first plant in the entire country to do so. So that gave us a huge cash, generation because of that. Even the cement was doing with the kind of fuel consumption and power consumption, only cement would have been difficult to run. But ours still being 1 million ton, a small capacity, we would be more focused on penetrating deeper, because if you're selling close to the cement plant, your logistic costs are going to be in control and you would realize better margins. So for a small plant like ours, which is located very close to, we already have a locational advantage because small plant like ours, we are very close to the consuming markets. So our strategy is, we are placed in such a position where, in a twilight zone. We're not a small plant, not a very large plant either, but then, we would be, because of the small nature of the plant, we will be excessively focusing on the local area which has got the capacity to consume the entire 1 million tons easily. In fact, the areas that we are serving, the market capacity or the market consumption in the areas that we are serving is around 25 to 30 million tons. So, for us, it is, our only focus is going to be penetrating deeper, because this market has the capacity to consume this capacity.
Good to hear, sir. That's it from my side. All the best.
Thank you, Priyaji.
Thank you very much. The next question is from the line of Uday from MK Capital. Please go ahead.
I am audible.
Yes, sir, you're
Yes,
audible.
Udayji, please go ahead.
Yes. So the first one is, can you please provide a timeline for achieving full operational ramp-up post-clean commissioning?
So technically, we are, we are hoping to reach it by the end of this quarter or the mid of next quarter. The ramp-up is going on slowly. In fact, when we started, we could produce only about 30-40%, but now we have reached almost 60-65%. So the kiln capacity to reach its optimum level maybe another a month or 2 months or so. So that's a timeline what our consultants have given us, and we will be confident to achieve that.
Okay. And the second is, what internal KPI or benchmarks does management track regularly to assess operational and financial performance?
The most important KPI that we look at is the fuel consumption, the power consumption values. And that is the major focus of the management right now, apart from other KPIs which, are standard in the industry. But for now, fuel consumption is something which we are extremely focused on. We want to achieve the fuel consumption typical, which is standard in the cement industry.
Okay. And how has per dealer or channel retention and satisfaction been during FY25, especially at volatile pricing?
So we retained, I think, almost 100% of our dealers, clearing few here and there who are extremely price sensitive. Like again, being a small plant, there are going to be certain advantages where the reach is going to be very aggressive for the existing market. And yes, typically we have been successful in retaining all our dealers. And now with this new expansion, we are going after a bigger network too. In fact, there are few dealers who are always consuming large quantities, whom we were not able to approach earlier, again because of the capacity and the other restrictions. But now, this gives us the benefit of approaching not only large dealers, like I said earlier, to institutional buyers as well as government-related projects.
Okay. And I also wanted to know what is the planned maintenance schedule or capex allocation for existing solar cement assets in FY26?
So capex allocation for FY26, unless we come up with 30 megawatt, there is not going to be any capex. But if there is a capex, the typical project cost is going to be around 130 to 135 crores for a 30 megawatt solar plant.
So that's great.
The entire capex, yeah.
Yes, sorry, so please continue.
Sure, please go ahead.
Okay, the last one.
Typically, we will be approaching the bank and, getting that funded through a nationalized bank only.
Okay, and is company addressing employee upskilling or recruitment to match the scale up of our new operations?
We have hired a significant new employees for the new plant, as well as two places we have hired most of the new manpower. One for the plant where we have installed new machinery, high-tech equipments, and the other side is the sales executives where we have added a significant portion and added more people to the area to increase our penetration.
Okay, that's it from my side. Thank you for my answer.
Thank you, Vijay.
Thank you very much. The next question is from the line of Bharat Gupta from Fair Value Capital. Please go ahead.
Thanks for the follow-up, Venkatesh. Sir, in regard to your remarks, like with respect to breakthrough, with respect to government orders, so just wanted to check, like, how much capacity are we planning? Like, I think we will be utilizing 50% of the overall capacity. So how much we are like looking forward for booking towards the B2C side of the business in comparison to B2C side?
B2B versus B2C, right? So breakthrough in the sense that there is this, foot in the door as such right now. So once, I think so to begin with, it is going to be very small and insignificant quantities, but then as we progress, as we see there is a possibility, the share of B2B will continue to improve. In fact, it is observed that the pricing given by the government is better compared to the retail pricing. So company will focus on, trying to penetrate deep into government-related projects. So once we get a foot in the door, like I said, it is not going to be very significant at the beginning, but we are hoping once that goes through, the quarter on quarter will start increasing. Figuratively, it is extremely difficult to give the percentage. All that I can say is like, it might begin with about 4 to 5% of our total care, this thing, and quarter on quarter it will keep increasing.
And just to understand, sir, what will be the credit terms in terms of getting out a project from the government side versus Like, how are our credit policies from the retail?
So if you look at our debtor days, it is around 16 days or so. So we have maintained a tight, cement plant. Typically, if you look at all other cement plants, we are pretty much in line with those, maybe 16 to 20 days or debtor days. With government, it might be up to 30 days. But then we're getting also a better pricing. So that would be this would be pretty much what will happen in this year also. Last year, our debtor days increased mainly because of, bad demand and, not lowering of dispatches, but we are hoping to improve it this financial year, which is already seeing increased cement consumption in the market.
And sir, if I look at the retail side, so how do we fare in pricing terms versus the likes of JK and Dalmia, which are also present nearby?
So till last year, we were, typically what I say and unofficially is pretty much like, there are a couple of plants in India which are on the national level. I consider them as tier one. And then like there are a lot of other cement plants between 1 million to 10 or 15 million capacity who are not on the national level, but they are significantly in pockets of maybe southern regions of India. So there was a huge price arbitrage between, tier two and like ours earlier. And as such, in the beginning, we don't expect to close it because we want to market and, do an aggressive sales. But eventually, there will be a point in time our pricing will start getting close to tier two brands. I believe right now, the pricing difference is almost like 600 rupees per ton, 600 to 7 rupees per ton between ours and the tier two brands. And, maybe almost around 1,000 rupees from tier one to our brand. But that gap will start reducing, as we go with higher capacity and start reaching out to bigger institutional buyers. Because we are able to produce the same quality and everything.
Right. With the same quality, I think, so the 600 rupees gap which is there, so I think that won't be the case with respect to government. There, the pricing will remain at par, so we'll be able to enjoy a higher realization.
We are, as of now, correct. The kind of breakthrough we're getting through is, for them the pricing is same. For us, the pricing is better because it is for us going from down to up. It may not be a very good pricing for a lot of tier one brands. So there is a scope for us to kind of fulfill that.
Right. And sir, just to reiterate, like the numbers which you mentioned, so PBT you are looking at near about 35 odd crores, which you said in my earlier question, I think.
Yes.
And sir, also,
so typically, I would assume, with the current pricing, come again.
Right. Yeah. I would just in a way with respect to 15-20% MAT rate which will be applicable to us. So I think we'll be anyhow somehow reaching out to 30 odd crores part given out the current realization trend, and with reaching out to 50% utilization.
Yes, it is possible. See, if the prices continue to improve the way they're doing right now. See, the biggest impact happened last year was, in spite of our dispatches increased by around 10-11%. We reached almost 257,000 tons dispatches last year compared to previous year of 246,000. We lost around 16 to 17 crore EBITDA only because of the decrease of the price. But the projections, what we had done earlier, was increasing the price by another 5%, which means that almost 700 rupees per ton we lost because of non-realization of the price as per the projected value. So having said that, if the projections stay at par, it is just a sudden mathematics that we will be reaching these kind of figures.
And sir, with respect to prioritization over solar versus the incremental addition towards cement capacity, I think we have a kiln installed of 1.8 million tons, which is a preferable thing, like post the stabilization of this unit of 1 million tons. Do you have any plans like with respect to FY27 or 28 to increase the further throughput to 1.8 million tons?
Yes, as the company continues to grow, the moment we have the stabilization cash flow generating, the next course of action is going to be addition in both renewable as well as cement. There is still a scope for us to improve the capacity in cement plant, but I think another 2 years So it'll be too early to discuss any kind of projections on that because our whole entire focus is to make sure that not only cement plant stabilizes, our sales and everything else also stabilizes. But yes, after a couple of years when everything, what we projection starts showing up, cement is also going to be on expansion stage, and we will continue to work on renewable power. Plus, there is going to be an RMC development too. So there are these three things are there where companies want to focus on eventually.
Right. And sir, like with respect to fundraise, so are we evaluating any strategy like, or we further like we can do a equity dilution or debt will be a preferable mode for funding out the projects going forward?
As such, with the current project in hand, what we have, which is what we're considering for 30 megawatt, we will go entirely with, funding from the banks. But yes, as we look for a much bigger expansions, anything that management feels will improve the shareholders as well, we will continue to focus on that. Equity dilution is not a problem as long as it ultimately gives well to all the stakeholders.
And any incentive which we have, sir, with respect to solar power from the state government?
For the existing plant, yes. That also for another few years. But for the new plant for 30 megawatt, what we are planning, there is no incentive if we sell the power, but it is incentivized, or rather, it's the same incentives across India, across all the states, if we consume it captively. So the strategy would be to set up a new plant for captive consumption and existing plant relieve the capacity for selling the power where incentives apply. So we don't have incentives directly, but indirectly we'll accrue the incentives because our strategy is to kind of build some capacity for captive consumption.
Sure, sir. The pricing trend has remained above 6 rupees for this last fiscal year, and currently, how do you see the trend in the pricing for solar?
Last year, I think so, we got an average price of around 5 rupee 90 paise or so. This year, we are beginning with around 6 rupees. Unfortunately, the price of power is being a very, very commodity. We're very much dependent on the regulatory, costs. So it looks like based on the current approvals or whatever guidelines we have, we should reasonably get around 6 rupees for this financial year. Because the last financial year, government reduced the price of power by almost 30-35 paisa for the industrial buyers to whom we sell. And even the commercial buyers, they reduced the price by nearly 2 rupees last year. But commercial buyers were not our significant. In fact, we had few commercial buyers. We shifted from them to, again, industrial consumers to whom we have already, signed an LOI. But yes, it is typically dependent on regulatory cost, and if that being stable, we will continue to get 6 rupees this year.
And sir, is it safe to assume that with respect to 70 crore plus EBITDA, which we are projecting for this year, nearly 30 to 35 odd crores will be coming out from solar and remaining from the cement. So the distribution will be 50-50 for both for this year?
Correct. Yes. Typically, yes.
Right. That's it from my side, sir. Thank you so much for answering all the questions.
Thank you, Bharji.
Thank you very much. As there are no further questions from the participants, I now hand the conference over to Mr. Harshal Ghanshyani. Thank you, and over to you, sir.
Yes, thank you. Thank you everyone for joining the conference call of Shri Keshav Cements and Infra Limited. If you have any queries, you can write us at research@kirinadvisors.com. Once again, thank you for joining the conference call. Thank you.
Thank you everyone.
Thank you very much. On behalf of Kirin Advisors Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.